Hi, this is Jim. Thank you for joining me today on my channel. Very much appreciate it. And there's been some news out, very significant news if you're interested in real estate. And that is that the Federal Reserve has increased the interest rates by 75 basis points. That's 0.75%. That's pretty significant. And it looks like they're going to continue to raise interest rates so they can combat some of the inflation that's out there. So that does affect mortgages and real estate. And how does it affect mortgages? Well, I did some calculations. So let's say you're going to buy a $300,000 house, not in California, but in Texas it's possible. I bought a house for $300,000, but let's look at the interest rates. When I bought my house at $300,000, I had a 2.9% interest on my mortgage. And that costs me about $1,200 a month, and it's a 30-year fix, everything else, so it looks pretty good. But today when I looked at interest rates today, I just typed in at Google mortgage interest rates, it's 7%, and that same amount of money, that $300,000, would cost $1,900. I bought a house in Texas, and I paid $285,000 for that house, and man, that is a beautiful house. I bought it around 3 or 4 years ago. It was a great house. Texas is a great place, and the reason why I'm investing in Texas and not California is because California is not business friendly and the taxes are high. Texas is business friendly and the taxes are basically low. So I decided that I want to do my future investments in Texas. So therefore I bought a house, $285,000. It's a beautiful house, 3-bedroom house, pristine condition, 2-car garage, beautiful neighborhood. I always pick neighborhoods where I feel safe, that my family could walk down the street at 12 midnight and not be harassed. And if my family can do it, then I feel safe enough to rent that house out to someone else. And this neighborhood is a quiet neighborhood. It's just a really nice neighborhood, and it's safe and everything else. Pleasant place to live. And I bought it for $285,000. I had an interest rate, as I already said, at 2.9%, and I put in the minimum amount of money. And the reason I put in the minimum amount of money is I wanted to hold on to my cash to buy more houses. So my payments are around $1,200 a month on that house. So it's a pretty good deal because I rent the house out for $1,900 a month, and I have some really good tenants in there, and that's pretty decent profit on the house, and it's going to increase over the years. The value of the house is going to increase. When it comes to rental properties, I don't really care if it increases in value. In fact, I'm a little bit concerned because it affects my taxes. What I care about is cash flow. As an investor, cash flow. I'm not interested in reselling this house. I probably will never resell this house. I will always use it as a cash flow instrument. And by the way, I got my deposit back. I put down a minimum deposit, and I've rented it out for a couple of years now, and I got that money back, so I can go use it on another house. But that's why I bought that house. Is because of all those features. Now, the next thing was I wanted to go out and buy another house. I'm an investor. I don't want the cash. Cash is affected by inflation in a bad way. Real estate is affected by inflation in a good way. So I don't want cash. I want to keep, of course, a minimum of cash to cover my expenses, but I don't want a lot of cash sitting around. That doesn't make sense to me. And it's not wise. So went out looking for other houses, I would say about a year later, after I felt comfortable with the area, after I felt comfortable with Texas, after I felt comfortable with all these things going on. And interest rates were still really low. 3% was a standard interest rate, so that's pretty decent. That's fantastic. That's the best interest rates that it's been in my whole lifetime. It was 3%. But to make a long story short, I went out there and I looked at these houses. And the houses weren't as nice as mine, and they were $50,000, $60,000 more. Now, I finally realized that, maybe I should just make an offer on a couple of them. And so I made offers on a couple, and I was outbid. I was outbid by my fellow Californians. They were taking, selling houses for $600,000-$700,000 in California, and they were coming out to Texas and seeing the same house, the same quality, the same, everything you could think about. They were seeing these houses for $350,000. So they wanted that house, and they had to move in. Their kids going to start school pretty soon, and they're doing remote employment, where they could be anywhere in the country, and they want to live in Texas. So when I would make an offer on a house for $350, or grudgingly saying this is just not as nice as the house I just bought a couple months ago, they would just throw money at it. They just throw money at it, and before I know it, that house that was listed at $350,000 was selling for $400,000, and the house next to it was selling for $425,000. So it became a feeding frenzy of buyers. They didn't care about the money. They're just going to throw the money out there at these houses just to get a house now. And they're saying, "Man, this is a good deal. I paid all this money in California, or got all this money in California. I bought this house for $200,000 20 years ago, and now it was worth $700,000. I got $700,000 cash in my pocket, or minus the mortgage, and I just need a house. And this is a house. I fell in love with the house. I always like that when people say I fell in love with the house. As a real estate investment person, I don't want to fall in love with any houses. I want the income of that house to be what to fall in love with, not the beauty of the house. That's for another video. I explain that later. So that was kind of interesting. Now, I don't know if I already... How does 75 basis points affect mortgages? Well, I got that mortgage, as I said, on my first house I bought in Texas at 2.9%, actually 3%, let's say, to round it up. 3% mortgage is $1,265 a month. So that's a lot of money, but it's not a killer type of thing. But today, if I was to borrow that same amount of money on that 3-bedroom house in Texas, it would have been $1,996, 7% interest rate. And so it does absolutely affect the mortgage industry. So it's now becoming a buyer's market. And the reason why it's becoming a buyer's market is because the buyers are drying up. There's very few out there buying houses, or fewer people buying houses today than there was just 2 years ago. And the reason why is because this mortgage increases have been going on for at least 6 months, a year now. And the cost of a mortgage is going up and up. And if you're a first-time buyer and you're just struggling to get a down payment, well, you got to have a mortgage, and so the payments now are a lot higher. So it kind of doesn't make sense to buy a house. You can rent a house, or you're just not going to have the income to justify, to qualify for a mortgage now, because the interest rates are higher. Therefore, the payments are higher. You got to, qualify for the house or for the mortgage, and so it's slowly shifting from a seller's market to a buyer's market. And that, if you're a real estate investor and you have cash, it's slowly turning to the point that now's the time to invest. As an example, I remember there was back in 2008, 2009 time frame in California, when we hit that super recession time frame, because a lot of people had adjustable rate mortgages, interest-only mortgages at that point. And so when the interest rates went up, they couldn't afford to keep their house. And I had a neighbor across the street, and the neighbor across the street was a good guy. He was in the trades, he was a carpenter, and he was a good guy. And I walked out of my house on a morning. I walked out of my house one morning, and I saw him with a moving truck there, and he's moving, and I walked over and asked him, what's going on? And he said, well, I missed a couple payments, and so I turned my house over to the bank, and they've repossessed the house. So I'm sorry to hear that. He said, well, life is what it is. And so I often, not often, but every once in a while, I'd hire him for to do carpentry work in in one of the residences that I owned. So I called him about 10 years later, 2018, 2019 timeframe, and I said to him, I got some work for you. Come out, take a look at it. He came out, and he was like all excited, everything. He was dancing and everything else, and twirling and happy. Gave me a big hug and everything else. And I said, "Hey, what's going on, man?" And he said, "What's going on is I bought a house today." And I said, "Well, congratulations, man." He said, "This is the first time I could buy a house since I lost that house back, when we were neighbors." And I said, "Great." And he told me about the price, good price, nice neighborhood and everything else. I'm really happy for him. He's a good guy. And I said, "So what did you pay? What was your interest rate on your mortgage?" And he said, "Interest rate? Who cares?" Well, interest rates, you better care. And the best time to negotiate an interest rate is before you buy the house and before you sign the mortgage payments. That's the time to negotiate interest rates. That's when I always negotiate. It's before the deal is signed, and you get better rates. And this makes a big difference. If you get an amortization charts and you work on the different amortization charts and you look at a different percentage, you're going to see it's significant. Mortgage rates percentages are significant. As you can see, 3% is $1,200, 7% is $1,900, $2,000 actually, it's closer to $2,000. But he didn't care. But as an investor, you better care if you're going to use a mortgage, or as a first-time buyer, you better care. It's important. It really is. Now, if you get a mortgage now, just remember, if it's high, if you're a first-time buyer, you can always refinance down the road. It's going to cost you money to refinance. Play with amortization charts. They'll teach you a ton. An amortization chart is going to show you all that you owe, all that you'll pay at interest rates, at different interest rates and stuff like that, and it will help you make a decision. Now, back in that 2000 time frame, the 2008 time frame, I bought a house. Mortgages were going down. People were not mortgages. Mortgages were going up. So back in 2008, 2009, I think it was 2010 actually, the housing market was quickly becoming a buyer's market. And actually, it was a buyer's market at that point. A lot of houses were being foreclosed on, and a lot of houses at the same time were good deals. The prices were dropping left and right, and I found a beautiful house here in California, in Oceanside, and it was really well kept, nice neighborhood. Loved the neighborhood, by the way. I could live there. It's a beautiful neighborhood, beautiful house, and I bought it really very inexpensively. I think I paid around $300,000 for the house, and now the house is worth around $600,000-$700,000, and it's about the same size as that house in Texas. And I've had it rented out for 20 years, and it's been very profitable for me. So it's now turning into a buyer's market, not a seller's market. So now I expect I'm going to be going back to do some more research. I'm actually looking for as-is houses that you can't get mortgages on because the house is in such a condition that a mortgage company would not give a person a mortgage on. And that's okay, because I'm pretty good with the trades. I can do electrical, I can do plumbing, I can do roofing, I can do all those things that are necessary. Or I can also manage other trades to do those type of repairs. So I think I'm going to wrap it up on this video at this point. Thank you for watching. Very much appreciated. Look for interest rates to be going up higher. A great day for investors, a bad day for first-time home buyers that don't have cash. Thank you for your time. You have a great day.